Hello, social workers, mental health professionals, and change agents. Welcome to another episode, season 4 of the Social Work Rants podcast. I'm your host, Bas Moreno. Hope everybody is doing well. Thank you, everybody, for tuning in, tapping in wherever and however you're listening to the podcast or watching this podcast from. Because we on YouTube, so make sure you hit the subscribe button, that red subscribe button on YouTube. Type in the Social Work Rants podcast and it should pop up. You see my logo behind me. See that logo? Hit that red subscribe button. You can follow the podcast on Instagram at the Social Work Rants Podcast. That's all one word. You can follow the podcast on Twitter at Social Work Rants, all one word. You can follow the podcast on Facebook. Just type in the Social Work Rants Podcast, hit the like button, and you can tap in and follow and see all the craziness I post on all social media platforms, especially memes related to social work. So people get a kick out of those. So we're doing something a little different, something I've been wanting to do for quite a while now, and have a financial advisor to help our fellow social workers, our entrepreneurs, uh, those of us who have private practices and see how we could get more bang for our buck in our businesses. We leave jobs and we have 401ks we might put money into and then we forget about them and then like 2, 3 jobs later, we're like, oh snap, whatever happened to that money that I could use right now? Like I'm in a pinch. So we have a financial advisor today. So we're doing something a little different, a special treat. Take notes if you need to, because we'll be dropping some gems today. Some things I've learned along the way and since that pandemic first started in 2020. So Alex Casella, financial advisor, how you doing, my friend? Thank you for coming on.
Yeah, I'm doing very well. Thank you for having me today. I appreciate it.
No, of course. So let's get right into just let everybody know who you are and what you do and your funny twist of how you relate to social work actually.
Yeah, thanks, Baz. Yeah, I'm Alex Casella. I've been working in the financial services industry. I'm in my 12th year currently. And over the years, I've worked in a few different arenas. I worked for a very large agency at one point. I spent some time working in banking. And then a few years back, I kind of broke away and just went out on my own and working with a smaller group. Throughout the years, I've met a lot of different professionals. And going back about 6 or 7 years ago, while I was at the bank, I was introduced to a social worker who came to me, and she came to me with all these questions. She's like, when it comes to money, I know nothing. I'm terrible with my money. I really need help. So I was able to help her answer some questions and figure out a few things. And over the next few weeks of meeting her, she sent me some of her colleagues, some of her classmates that she knew who worked in social work or worked in the mental health field. And then a couple of years past that point, I meet my wife, who is also a social worker. And when we met, it was the same type of conversation when it came to money. She's like, I know nothing about my finances. I know a few things that my dad taught me, but I really don't know how much I should put into a retirement plan. I don't know, how much I should keep in my savings. So I was able to help her when we first started dating with some of her finances. And just from those two relationships, I've been introduced to a lot of different social workers. And I really, through the pandemic, talking about the pandemic, leading up to that point, I saw that there's this opportunity to help social workers and people who work in mental health because you're not receiving a lot of training in financial literacy, right? You put a lot of right? You put a lot of hours into your training. You put a lot of hours into your careers, your caseloads, right? And if you do want to have any financial literacy, you have to go out there and do it on your own. So it becomes a challenge because I know social workers, right? Their passions are helping people, right? They're putting their all the energy into their career to really help people, right? So thinking about money becomes an afterthought. But the reality is, our money is important. We need money to survive. We need money to operate our households, to operate our businesses, and one day to retire, right? So all these financial topics that I'm bringing up are very important. So I found this as an opportunity to help social workers because I see the work they're doing in trying to better the world and really empower our communities. So I want to help them to really just organize and prioritize their money so that they can retire one day, really.
Oh yeah,
So
absolutely. Retirement is the name of the game, and who knows what's going on with Social Security. We talking about maybe like 2034 being the end of
yeah,
Social Security supposedly, and even though there's a 2022, there's a 5.9% increase in Social Security benefits for those who get benefits. So
right.
I don't know how that plays out. That might end Social Security even quicker, but who knows? But
Yep.
between that and just we work hard for our money, and we need to learn how to maximize retirement plans. What's actually inside 401ks and there's 403bs. What's the difference between a 401k, 403b? Well, people have state jobs, so there's 557 plans in place. I know I had one for a little bit and putting money into that. So it was like all these different plans. We don't know what exactly what's in them unless we really
Right.
do the research and all that comes into play. So how much money to
Yeah.
put into them, and is it enough? Is it too little? I'm for myself, I'm like 42. I just started putting money in the 401k just like this past year, and it's like, am I late to the game? Like, what am I doing? So
Right. Right. Yeah, everything you're bringing up is spot on. I mean, recently, we're seeing record high inflation, right? We're seeing record high increases. So the Social Security increase for the cost of living, it's one of the biggest adjustments we've seen, biggest increases. And after learning about that statistic, they are saying that Social Security will sustain itself until 2034. So that means we got 12 years left, right? So, what does that mean? Well, since I've started in this business, dating back to 2008, 2009, those were things I was hearing then too, that Social Security is not going to be able to sustain itself, right? So we've been hearing that for a while. The truth of the matter is we don't know, right? Based on the numbers we currently know, it's only got 12 years left. Could that change? Potentially, right? But what does that mean? That means we have to plan, right? We have to plan outside of Social Security. We can't rely on it. If it's there, if there's something there, great, but we can't rely on it, right? So planning for retirement is super important. Beyond, the inflation, beyond Social Security and whether or not that's going to be around. The other things to think about are like healthcare, right? Right now, our healthcare system has been, tried through the pandemic, and we're seeing healthcare inflation, right? Which is predicted to outpace just general inflation. So what does that mean? When we get to retirement, if we want to retire before the current Medicare age of 65, well, how can we do that? Can we do that? Because the cost of health insurance outside of the Affordable Care Act, outside of the exchange plans, those plans can become very expensive, very costly on your own to afford health insurance if you're not working, right? So if you want to
absolutely.
retire before the age of 65, well, you could do that, but you have to make that part of your plan because the cost of healthcare is predicted to increase over time as well. So there's just more and more reasons as to why planning for retirement is very, very important, right? And as you mentioned, you're in your early 40s. There are, and what I say to people is like, the earlier you can start planning for retirement, the better, right? So you're starting out in your career, you just finished your master's, maybe you're getting a clinical license, whatever the case is, start as soon as you can, even if it's a small amount, right? If you've waited some time and you've not, started putting money in, it's okay. Don't beat yourself up over it. Just get started, figure out what that amount can be. And then when you get to a certain age, the way the current laws are written, there are certain provisions to allow you to catch up, right? So if you reach age 55 or older, there are additional contribution amounts you can put in to things like IRAs and things like that. So they allow you to put in more money to start catching up with your retirement planning. But the goal here is really just to really sit down. One of the activities I talk to people about all the time is just to look at your cash flow. When you look at your cash flow, you know what's coming in, you know what's going out, right? You have an idea of what your spending looks like. When you know what your spending looks like, now you can take a look at your retirement planning and say, like, okay, how much can I realistically put away? Can I put 1% of my income away? Can I put 5% of my income? Can I put 10% of my income away? Are there any matches that I'm getting from my employer? Match means free money, right? It means your employer is giving you money to put into your retirement account for you. You want to take advantage of those matches, right? Because that's money that nobody else will really give you toward retirement. So everything I'm saying here is very critical and important, because we want to retire one day. We don't want to work for the rest of our lives.
Yes, exactly.
Yeah. So so that was a long-winded answer to say everything you mentioned is very, very important.
Yeah, and I just wanted to touch on real quick because we see all these Instagram influencers and all these entrepreneurs talk about how they're making money, buy my course, buy this, buy that, and there's so many entrepreneurs, but nobody really talks about, like you mentioned, the health insurance being so expensive. Like, what's the best way if somebody just has a private practice, they don't work in a nonprofit, they're not working in the school setting, anywhere that they could get insurance through their employer, and they're self-employed. What's the best bet for them to get insurance?
Yeah. Yeah. So when people are self-employed, oftentimes that means you don't qualify for employee sponsored benefits, right? So you have to go out and get them on your own. In some cases, there are some, people who are self-employed, some clinicians who might get it through a spouse or a partner. Beyond that, there are some affiliations. If you're part of certain groups, you might be able to qualify for group related benefits through like an association. And outside of that, you can really take a look at at your state level, what's available through your exchange. And those plans that are available through the exchange have to do with how much money you're making. So the plans on the exchange offer subsidy if your income falls below certain limits, right? So you have to go through a little bit of a process, fill out some income information, and see if you qualify for subsidy through an exchange plan. But yeah, outside of that, you could go to private insurance companies and see what plans are offered as well.
Now, the exchange, is that the same thing as the marketplace like a few years ago?
The marketplace, yeah,
okay.
The marketplace, exactly, yeah.
Gotcha.
Yep.
And this is for my out of U.S. listeners. This we're just talking about insurance here in America. I know there's other countries with way better insurance and stuff that there is here in America. We're talking about just the United States of America. So
yeah. Unfortunately, we're not there yet with regard to like a universal type of healthcare system, outside of Medicare. So based, how our current laws are written, that's how you would, obtain health insurance at this point.
Okay. So I've been in social work, 20 years, and a lot of my jobs I've had didn't even offer a 401k or 403b or anything like that. Just your salary and your health benefits, and then maybe some like group life insurance, something like that. But so what's the best way if somebody was like, hey, I want to put money into a 401k or 403b? How can someone go about doing that?
Yeah, so I think it'd be helpful to kind of identify what those terms are that you're saying, to kind of just help people give some clarity. So when we say things like 401k, 403b, 457, right? Those are all retirement plans that are available through a type of employer, right? So and the number, right, has to do with the type of employer. So when you hear 401k, right, that's the section of the tax code that is specific to a private company, right, that's offering a retirement plan. So a 401k would be if you're working for, a private company. When you hear 403B, right, usually that's associated with municipalities, like individuals who might work with a school system. So like a school social worker might get a 403B. When you hear 457A, those are certain types of government retirement plans, right? For individuals who might work for like the VA hospital or a federal employee, they have the TSP, the Thrift Savings Plan, right? So these are all different types of retirement accounts. At the end of the day, uh, I, I want to say they're the same, right? But it's just the section of the tax code that they fall underneath, right? That identifies the different type of employers that offers them, right? So when you work for a company, like a private company, a school, a government agency, these are offered to you, right? So when they're offered to you, when you start out in the job, or if you're currently working in the job, you want to go through HR. You want to take a look at the benefits, right? Oftentimes, those benefits are available through like an online portal. You go to those online portals and find out how you sign up, whether it's you set it up online, or you have to make a phone call, you have to fill out some paperwork. I have to imagine in today's day and age, I haven't seen anybody really fill out a form to set up a 401k or a retirement plan. And you set it up through those online portals, right? So that's when you're working for a company, right? You have 401ks, 403bs, all those different numbers and letters that I've been mentioning. Outside of that, if you are working in your own practice or you're self-employed in some way, you can open up what's known as a self-employed IRA, right? So there's things like SEP IRAs. SEP stands for self-employee pension, right? So those are specific to people who are working for themselves, right? And when you look at retirement plans that are for individuals, right, that are not associated with an employer, right, they're referred to as an IRA. An IRA stands for individual retirement account, right? So when you look at 401k and employee sponsored plans, you look at IRAs, there are different limits to the amount of money you can contribute, right? You can contribute less money into an IRA than you can into a 401k. You can put a lot more money into the 401k than you can the IRA. So people who are self-employed can open up those SEP IRAs that I spoke about, and those have higher limits than the just a regular old IRA, right? So the people who again are self-employed, you can go through a lot of different avenues to establish one. You can work through a financial professional, someone like myself, someone you maybe already have a relationship with, or you can go directly to a company. This is in no way, shape, or form a recommendation. I'm just purely pulling a name, a popular name. A company like Fidelity, right? You can go to a Fidelity, you can go to a Vanguard, right? These are all companies that offer things like SEP IRAs or IRAs. And you would go to them to establish those, and then you would determine how much you would want to contribute to them each month or each week or each quarter, whatever you determine best. So I hope that helps kind of clarify your question, Baz.
No, it does not. No, I've met, especially through the podcast, so many social workers who have private practices or just their small business, and like we like talk about, our MSW program didn't teach us not a damn thing about how to start a business. It's like they go open
Yeah.
a private practice, but like, okay, how do you form like LLCs or like S corps?
Right.
Just all that comes with starting a business and setting up a business properly. None of that is been taught in grad school, and I hope
Right.
eventually that changes, especially while we still in the pandemic, moving forward or afterwards, with so many people starting businesses for the first time, like myself included. So just learning and just providing the info for my fellow peers and that they need. So
Right.
that how can like if somebody has money like in an account, like you mentioned it pretty much for the most part one and the same, 401k or 457. If somebody has like say like $8,000 in an account, just a random number to make the math easier. What can, and they're no longer at the job. What can they do, with that money? Like, hey, I forgot I had this money in this account like 2 jobs ago. Like, what can I do with this money?
Yeah, great question. And I do see it often. This happens not just in the mental health world, but it happens in a lot of different fields where, individual starts out working for a certain agency, a certain group, and they leave there, go to another group, and then they leave there and go to another place where now they're going to stay there for a while. And while they were at those prior employers, they had retirement accounts that they put money into. And then what they don't realize is when they left and, that company, that money actually, that retirement account actually stayed behind. So, to answer that question, when you leave a retirement account behind at an old employer, you don't have much access or control of that 401k or that retirement account. So what do I mean by that? The way the current rules are written with regard to retirement accounts, you need to be an active employee of a company or an agency in order to make changes to a retirement account. So when I say make changes, that means like change the investment type, like maybe go from one fund into another, right? So you can't make changes to it and you have no access to it. So what do I mean by that? Well, if you want to, let's say, take a loan against your retirement account, maybe for like a first time home purchase, right? Because you're not actively working that employer, you can't loan against it, right? So you really give up control of that 401k or that 403b when you're no longer working at that company, right? Beyond that, let's say you did take a loan against a retirement account while you were working at a certain company, and then you decide to leave and go to another company. Well, when you leave and go to that new company, or let's say you're terminated, God forbid, the loan that's held against that 401k at that point is due immediately, right? So there's a lot of things that you lose control of when you leave a company and go to a company with regard to the retirement account. So what can you do to regain access and regain control of that retirement account? Well, you can move it into the new employer, right? So if you have your job that you're happy with, you're planning to stay there for a while, you can do what's known as a 401k rollover or 403b rollover. Then what you're doing is you're taking the money from the old employer and you're just rolling it over into your new retirement account at your new job, right? That's one thing you can do. The second thing you can do is roll it over into an individual retirement account, right? So an individual retirement account is something you own individually. It's not set up through your employer. You have access to whatever company you want to work with. You have access to several different funds available to you, and you kind of control it, right? So you decide how you want it to be invested. You decide what company you want it to be with, and then you can say, you know what, I want to make a change to this. I want to go to a different company, or I want to change it into a different fund. You have control of that retirement account when it's in an individual retirement account, or if you roll it over into the new 401k. So that's a great question because I do see it a lot, and you definitely don't want to leave it behind. The other thing that people that individuals think they can do, which you can, is they want to take that retirement account and now they want to put it into their savings account. They say, you know what, you use the number 8,000. So they said, I have 8,000 that is held at my old job. Let me take that $8,000 and just put it in my savings account, and I'm going to just leave it in my savings. You could do that, but what you do when you take money out of a retirement account is a couple of things. There's a pre-withdrawal penalty on retirement accounts, right? That pre-withdrawal penalty is 10%, right? So off the bat, you're paying on $8,000, you're paying 10% of that, which is $800. My math is right,
Yeah.
right? So off the bat, you're paying $800. So now you're walking away with $7,200. You just lost $800 paying a penalty. The reason behind that penalty is the government really wants to force us to save money for retirement, right? So they're trying to keep us from making those withdrawals. The second thing, depending on the type of retirement account, and I can get into this in another minute, but depending on the type of retirement account it is, whether it's a traditional or what's known as a Roth retirement account, there could be income taxes you have to pay as well, right? So you're taking an $8,000 distribution against your retirement account. you're going to pay the 10% penalty. And then you have to also show it as income, meaning you're going to pay taxes on that withdrawal as well. So now your $8,000 might look like $6,000 or $5,500, right? So you're taking a haircut to take money out of that retirement account. So it's usually best to put it into either your new 401k or open up an IRA in that situation.
That's it. And not to mention, you're not going to get any interest from the bank anyway. Even
that's
an online
another
account,
consideration, right? Yeah.
even
Yeah,
an
you're not
online
gonna,
account
get
is only like 0.5%.
exactly. You're going to get nominal growth on that money. You're going to lose money with
Yes.
with inflation.
And inflation on top of that. So
Exactly.
but that's that really good info. I know it's something that I've been for myself even meaning to do with my old job, like having a 457 IRA, like Roth. Like what's the difference between a Roth IRA and a regular IRA?
Yeah, great question. So in the world of retirement accounts, whether it's like a 401k, 403b, or an IRA, we have a traditional retirement account and a Roth retirement account. And the main difference is how the taxes are treated. So in a traditional account, you receive a tax deduction for the contribution, so the amount you put in. So just to make the math easy, somebody makes $50,000 per year. They put in $10,000 into a traditional retirement account. They will only pay taxes on $40,000. So what that means is $50,000 minus the $10,000 contribution. You're only paying taxes on $40,000. Well, now in a traditional account, when somebody retires down the road, when they go to take money out of that account, they are now paying income taxes every time they take money out, right? So when you take money out in retirement of a traditional account, you pay income taxes because the government gave you a tax deduction years ago and you put it in. They now say, we want our taxes, so you're going to pay it to us when you pay when you take money out. The Roth is the opposite. So a Roth account, when you put money in, you do not pay taxes on the contributions. It's after tax dollar contributions. So that same example, somebody makes $50,000, they contribute $10,000. They are still paying taxes on $50,000. There's no tax deduction involved when you contribute to a Roth account. Fast forward again into retirement. Now you're going to take money out of that retirement account. There's no taxes on a Roth distribution. So that means it's tax-free income from a Roth account in retirement. So those are the main differences. Again, traditional, you're going to get a tax deduction on it now. And apologize, stumbled on my words. You're going to get a tax deduction. You're going to get a tax addiction. It just doesn't make any sense. No one wants to be addicted to taxes.
Exactly.
A little comic relief there. But yeah, no taxes on tax deduction on traditional and tax income in retirement. With the Roth, you're not paying taxes on the contribution and it'll be tax-free in retirement.
Awesome. Yeah, we don't want to be addicted to paying all this tax. We barely want to pay taxes as it is. I mean, we pay our taxes, but we don't want to.
Yeah.
It's funny. It's like we don't want to pay taxes, but we want that refund when it comes.
Right. Yeah. Yeah, it's an interesting point. When you talk about taxes, though, just I guess to pivot here, when people think of getting their tax refund, right? We're going to be going into that season very soon now. People, and it works for some people, and that's fine. But when you think about it, when you receive a large tax refund, right? When you do your taxes, that means you overpaid to the government, right? So whatever the dollar amount is, $2,000, $3,000, whatever it is, that means you overpaid the government by that much money. And when you gave it to the government, they did not give you any interest back. So they got a 0% loan from you for the amount you overpaid. So when you're getting a large refund, think about it. Some people say, yeah, I know, but I really rely on getting that money. Okay, that's fine. But maybe if that $3,000, $4,000 is put it to work for you somewhere else, it can grow a little better. So yeah, just something to think about there.
Yeah, it's one of the I'm not a supporter of 45, but that's one of like the few good things that he did and try to change that. I mean, initially it was a little bumpy. Even when I did my taxes, my tax prepare was like, what the heck did he do? Like, it just made my job like a little harder. But I guess the intent was there of him trying to like get more bang for your buck in your paycheck
Right.
and not having to like rely on getting all this money back. Because like you
Right.
said, you are like overpaying, for your taxes. So
Yeah.
for me, I like both. I like, okay, let me see my my check, like get more bang for my buck, like every 2 weeks on my check, and then like at the end of the year, I still want my money.
Right. Yeah. I know what you mean. Yeah. Absolutely. Absolutely. Yeah, and I should disclose and say, like, this in no way, shape, or form again is me giving tax advice. I'm not a CPA by any means. Obviously, I help people with these conversations, but I'm not. This is not specific tax advice that I'm giving to people, but it's really just to get you thinking about, like, what's your money mindset? How do you see your money growing? When you get that lump sum check from your tax refund, well, if that dollar amount was able to get, 5, 6, 7, 8%, I don't know, I'm just making these numbers up, I guess,
Yeah, yeah,
but that's really where, again, you can kind of have that money mindset to say, I can put my money to work for me. I definitely recommend, if you're not working with a tax professional, whether it's like a bookkeeper or CPA, whatever, tax preparer, it's definitely worth the money you pay them, because they're able to help you to really maximize your and make your income most efficient, right? So definitely something I recommend.
yeah, and I absolutely, and I started working with a good CPA, and I was constantly asking questions as I was like doing something new, make sure I was doing doing it right, and like making sure like I don't need Uncle Sam coming asking me for money that I may not have. So like,
Absolutely.
so it's worth investing in a good CPA. So,
Yep.
speaking of taxes and taxable income and getting large checks from from your tax return, as tax season is like fast approaching. um I know once Christmas and New Year's passing, like I'm already like looking at my watch, like when this W-2 is coming from my
Yep.
job, so I could file and all my bank statements and everything, and get my paperwork in order to file. So,
Right.
um, within the pandemic, and even like just like right before like late 2019, most of 2020 and into 2021, there been a lot of amazing social workers that either left their jobs, went full time entrepreneur, or they started a LLC, their online business, whatever type of business. I see so many people start their businesses uh, within the last 2 years and change, and which is great and it's beautiful to see. And so many of them are Black and brown folks, starting businesses. But related to taxes, you got to pay taxes. Like, even though you might have a loss, like you might not have made initially any money in your business, like you like save all your receipts, and you spend this money because you need this for your business, you need that for your business, a laptop, phone, whatever it is, and talk about write-offs and stuff, and you pay your taxes, not only like your personal, but also for your business. What is the like tax benefits for people who are not educated or don't know about the tax code? Um, and you mentioned like the money that's four, five, six, seven, eight, $1,000 like refund. Like you might actually see that money if you file both personal and business.
Yeah, absolutely. And to, I guess, quickly just compliment those people who did leave during the pandemic and decide, like, I'm going to go and give this a shot. Like, congratulations, kudos to you guys. Being an entrepreneur is a really cool thing. Takes a lot of work and effort, and the fact that you did that, I think, is courageous and deserves a compliment for sure. So when you are working for yourself and you're receiving your own income in that way, what that means is now you have to file that income when you file your taxes. When we work for a company, we receive the form of income we receive as a W-2 employee means our taxes are taken out from our paychecks. And at the end of the year, we get the tax form in the mail, we file our taxes, and we usually get money back, or maybe we owe a little bit depending on how things fell. But when you are operating as your own sole proprietor, or if maybe you set up an LLC or incorporate, whatever the case is, now that means you're responsible for also filing that income, right? You have to show that income. And when you are operating in that way and receiving your own income from whether it's insurance providers or you're getting paid directly from the individuals you work with, you can also deduct your own business expenses. So what does that mean? When you, and Baz, you mentioned this, when you have to purchase a laptop, when you have to purchase equipment to do telehealth, when you have to purchase a printer, when you have a cell phone that you use for your business, right? All those things are business expenses. And you need those things in order to generate income for that business, right? So when you have those business expenses, that means you can deduct them from your taxable income. So, I'm just going to, again, make up these numbers. But if somebody earns $50,000 being in their own private practice, right? They had to spend $15,000 on business expenses, right? Now, when you go to file your taxes, you're going to show that income, you're going to show those expenses, and your adjusted gross income for the business, or your net income for the business after your expenses, is now, what did I say? 50 minus 15, 35,000, right? So you're only going to pay taxes on 35,000 for the business, right? You're going to lower your taxable income from 50,000 down to 35 because you spent $15,000 from your business in order to make that money. Okay. So now when somebody is,
let's cut you off, but what's the good thing about that? Like someone who just like, it's almost like second nature, like, or just like file your taxes, but what's the actual benefit of that? Because it's a major gem, and I don't want like people to like not take it for granted, regarding that.
Yeah. So the major advantages are, you're going to lower your taxable income, right? So if you just show you made $50,000, right? I don't know what the exact number would be, but again, I'm just going to make this number up to show an example. But let's say on $50,000 between your federal, your state income taxes, whatever other taxes, right? Let's say that amount of money is $10,000, right? So you now have to pay $10,000 in taxes for that $50,000. If you lower it to $35,000 with $15,000 worth of business expenses, well, now your tax bill might only be, again, this is just a number, it might only be $3,000, right? So you're going to save yourself money in taxes. Beyond that, though, you could be in a scenario where you maybe pay no taxes for your business. And again, I'm not I'm not saying that anybody on this podcast will not pay taxes, but what I am saying is if this is your first year in practice, right? 2021 was your first year in practice, and you had to spend $15,000 to get your business up and running, you only made $10,000. Well, you're going to show a loss. You're not going to pay any taxes, right? So those business expenses become very important. Beyond that, right? When you have a private practice, some type of business, and you also are working a job, you're working a W-2, right? Well, that means you have two sources of income. And at the end of the day, when you file your taxes, you're filing for the combined amount, right? So what you're saying is, my full-time job, I make $50,000. That's a W-2. My business income was $25,000, right? So 50 plus 25 is 75,000, right? So now I'm paying taxes on $75,000. And when you look at what's known as marginal tax rates, what that means is, marginal tax rates basically are our income is broken down into different amounts, right? So it goes from $0 to $9,999, right? And then it'll go from $10,000 to $20,000. I don't memorize the exact amounts, but basically the first $10,000, right, is going to be taxed at 0%. This is federal I'm talking about. The next, let's call it 10 to 20,000, is going to be taxed at 12%, right? And then the next chunk up from there is going to be taxed at 20%, 22%, and it keeps going up from there.
Yeah.
So what could happen is when you are paying your full-time job, when you are paying the taxes there based on being in a certain tax bracket, and then you add in an additional $25,000 of business income on top of that, well, that might bump you into the next tax bracket, meaning you're not only going to owe money on the business income taxes, but you might owe more money on the W-2 income from your employer, because now you're in a higher tax bracket, right? So, this taxes can get a little confusing, and that's why I'm trying to go slow and keep it like, a higher level here. But, those business expenses become very important because it can help you from going into the next tax bracket. It could help you from paying additional taxes. So, again, 2021 is your year. You went into business and you're like, I'm going to keep working the job. I'm going to start my business up. And then you're used to getting a $3,000 refund in February or March. And now next thing you know, you're owing money. You're not getting that money. So, taxes becomes very important when you are operating as a sole proprietor. So does that help answer your question?
Yeah, absolutely. And also because making all these deductions for your business, or if you didn't make any money, a loss, especially if your first year, you may actually see, because your taxable income was reduced, you may actually see possibly a bigger income than your bigger refund that you're used to seeing as well, which might come in handy. So it depends, if you made money, lost money, depending what type of business, like the tax brackets you in. So it's it's something to think about, but definitely it's something worth learning, especially tax codes and things of that nature. When you see that on the news and you see our annoying politicians talk about that, learn, because it's your business and your money, and you don't want to be paying more taxes that you don't need to. You're already putting money into your business, so
yeah,
get more bang for your buck.
absolutely.
No, but I appreciate the breakdown. And again, Alex is not a CPA, neither myself, but it's something that obviously he's learned from working with individuals, and it's something that I'm still learning for myself. So and I'm when I did my business in 2020, and when I filed, I was like, oh snap.
Yeah, a whole new world.
I was, and then in a good way, I was like, oh snap, I get this money back because I've actually filed an LLC and like gave you like everything I spent money on. And it was like, so I was more than happy. So I'm hoping for a similar situation.
Yeah,
next March, April.
Yeah, and it's interesting, as you were saying that, when we start out in practice, and we're trying to be mindful of our spending, of course, right? Sometimes I spend time talking to people about reduce spending, right? Or just be careful what you're spending on. But then on the other hand, you have to spend money to make money, right? Exactly. I guess. So when and this is like something I've always, it's like one of the things that is ingrained in me, like sometimes you have to go to the experts, right? So yeah, you might have to pay a fee to an accountant or a CPA or a tax prep person, and you say to yourself, well, gee, I'd rather save that money. I can do it myself through whatever,
TurboTax.
yeah, this is not an endorsement, but a
No.
TurboTax or whatever the case is, right? Whatever online prep company or program. But if you go through a tax person, right, they might be able to, they might be a little bit more familiar with certain types of deductions or tax credits that will ultimately help you. Whereas if you went through, something you did on your
If you
own,
did it yourself, right?
you're right, you might not get that, right? So sometimes the fee you're paying will get you more, and get things set up properly as well. So less likely to have like an audit situation or something like that. So definitely, I that's something I live by is like, you know what, I'm not an expert in this field, so I'm going to go to the expert and pay that expert because that's what they're there for, So just
Yes,
something to keep in mind.
yes,
Yeah.
and especially if you started your business, definitely go see a CPA and get all these tax breaks and get whatever you get. Because I started a business in my first year filing business taxes. I'm paying somebody to do. I usually pay
Yeah.
somebody to do my taxes anyway, but I'm not trying to like pay no lump sum to the IRS because I messed up on the business side,
Right.
not knowing what the hell I was doing. And like, nope, like, I'm
Right.
going.
Yeah.
I got recommended somebody. I went right to that person, and like,
Perfect.
I'm on the phone call. Like, I heard this. Can I do this? Like, I heard this. Can I do this? Like,
Yeah.
so like, so it is what it is. So, um, myself included, I know many social workers who have kids. What can financially, what can we do as parents to make sure like our kids are straight in terms of finances and anything like we do from a job perspective, whether it's, not only like putting our kids on the health insurance through their job, but I'm talking about in terms of regarding 401ks. I know there's like a 529 plans. There's like UTMA accounts that it could open up for the kids, and like
Mhm.
if you could go more depth into that.
Yeah, absolutely. And you started off with something interesting about the health insurance. So my wife and I had a baby this year, 5 months
Congratulations.
ago. Thank you. Actually, 5 months ago today, and can't believe how quickly he's growing. So everything that I'm telling you is actually part of my world now, and something we're actively going through on our own. But with the health insurance is one thing we didn't realize is like the day he's born, like you have to call the insurance company now, right?
Yes.
So like a week went by and like our doctor's calling us and we're like, oh yeah, we didn't know we have to, you have to add it to the health plan. So, so health insurance is very important because we're learning that children go to the doctors a lot for their checkups, and even when they have a little cough or something goes on, we're bringing them in.
Or some jobs are even good. Like, hey, my wife is pregnant. She's due any day now. Maybe they could do it as soon as you got the birth certificate. Like, send it to us. So like, I've had a job that actually brought me on their insurance. Like I changed jobs and they put me on like a month before like I was supposed to
Oh, cool.
start. So you definitely work with HR, regarding doing that. So if you have a good HR
Yeah.
person, you just or a good agency, you just never know.
Yeah, you're absolutely right. And my wife did reach out to like her HR person, and she's like, I know I have to call to get this done. Um, so definitely have a good relationship with HR. And in some cases, if you can negotiate getting onto a health plan early, like you did, Baz, that's perfect. But beyond that, things to think about are, and this is kind of planning 101, in terms of like how to operate and run your household when there's children, or even if there's not children, is, you always want to have an established emergency fund or some type of cushion, because at the end of the day, something happens with the kids, or, they want to participate in an activity, or holidays, birthdays, whatever the case is, you want to have cushions. You want to have cash reserves that you can turn to, right? So that when you need to, I don't know, I'm just going to make up braces because that's something I've been hearing is becoming popular. If you have to get the kids braces, something happened, they want to play on a sports team, and now you have to buy uniforms. Whatever the case is, you want to take a trip or a vacation, and like my wife and I realize now, if we go somewhere, it's not 2 plane tickets, it's 3, right? So, and so when you have money in a savings account, you can turn to that savings account and you have cash in hand, right? When we talk about access, and when I say access, that means like actually going in and taking the money out, right? Well, when we think about retirement accounts, we talked earlier about retirement accounts. We're not going to go into our retirement account to take money out. Reason why is because there's that 10% penalty. Beyond that 10% penalty, well, what if the market is down, right? What if we have another pandemic? Something happens, Omicron,
crash, right?
That just crashes, makes the market go down, right? And now we're taking money out of the market. We're getting a 10% penalty. Not where we want to go for paying for things like braces, right? Our emergency fund, right? Your local bank, wherever you do your banking, credit union, whatever the case is, the money's there. It's safe. It's boring. You're not going to get growth, but it's there. So you have an emergency fund, right? That's the first thing I would recommend, is establish an emergency fund for things like emergencies, or if you want to take trips, whatever the case is. Beyond that, right, in terms of planning for children, well, we want to potentially send them to school one day, right? Whether that be a university, vocational school, tech school, whatever the case is, we want to be able to plan for them so that they can train and get educated in a career path, right? So what are the things we can put money into for children? You mentioned 529 plans. 529 plans are higher education savings accounts for children, right? College savings plans. Each state has their own specific 529 plans that you can go to. And when you put money into a 529 plan, the money is earmarked for that child's education, and the money has to be used for education. If it's not used for education, there's again a 10% withdrawal penalty on that money, right? So when you earmark money for education, it has to be used toward education in a 529 plan. So that's one.
I heard it doesn't have to necessarily mean college. It could be anything, because they changed the law on that. I think it used to be for college specifically, but then it just changed for anything related to education.
Right, and that's why I mentioned the vocational school, tech schools. If your child decides they want to get into a trade, you can use the money toward that education, right? It can go toward textbooks. It can go toward room and board, right? So anything with regard to the education, the cost of education, right? And in some cases, people ask the question like, well, what happens if my child gets a scholarship? They get a full ride. Well, that's cool. I hope my kid gets a full ride. But the money could again, it could be used for textbooks. It could be used for room and board. You can use it toward a laptop. Or if you have multiple children, you can change the beneficiary on a 529 plan. So if it's earmarked for Baz, you get a full ride somewhere. Alex is the other child. Well, we're just going to change it out of Baz's name and make Alex now the beneficiary of the 529 plan. So now it can be used for Alex's college costs or education costs. So 529 plan is one path. It's specific to education, right? So the other things you could do for kids, and you mentioned UTMA, right? And what those are is UTMA stands for Uniform Transfer of a Minor Act, right? So that's a fancy way, it's a fancy title of saying the money, the owner of the money is the child, but the child is not the age of majority, right? So in some states, the age is 18, in some other states, it might be 21. So before that child reaches the age of majority, somebody needs to oversee that money, right? And that person is known as the custodian, right? So in an UTMA account, there's the owner, who's the child, and then there's a custodian, which is usually a parent, in some cases, maybe a grandparent, but somebody who is controlling that money in a sense, has the authority to put money in, take money out, right?
Right.
So in those two worlds that we talk about, what are the pros and cons? Well, again, 529 specific to education has to be used for education, right? The UTMA accounts doesn't have to be used for education. It could be used for anything, right? The child can't access the money until a certain age. So when the child reaches that age of majority, you can turn the money over to that child and say, here you go, here's some money we saved up for you. So there's no consequences, there's no penalties essentially on those accounts. The other thing too, and this is something people don't often think about, is a life insurance policy for a child. And from the standpoint of how a life insurance policy works, there's a lot of different types, and one of the types generates what's known as cash value, right? So cash value life insurance comes in a couple different forms, but you put money into a life insurance policy. That policy will generate cash value. That cash value will grow over time, right? And that's another vehicle that people sometimes use to save money for their children, whether that life insurance policy be on the child or it be on the parent themselves. That's another way people can generate savings for children, is to use life insurance policies. So does that help answer the question?
Yeah, absolutely. And something I learned that you could get a 529 plan. Say, for example, I'm in Delaware and you're in Connecticut. I could get a 529 plan in Connecticut. You don't have to do it in your own state that you currently reside. So that's something I didn't learn until like recently, and because I was like, because for a while I was living in New York. I'm like, New York's 529 plan is trash. I'm not doing this. All right, figure something out. So so that helps as well. And UGMAs is something I learned within the pandemic, and started putting money for my own kids too. And it's something it's no stock related accounts. So the stock market is doing well. Like you're going to see some extra green. If it's seeing some red, like it's
right.
You might see a loss of your money, but it's something. Get your kids involved, in the stock market, and you be like, you own a piece of Apple. You see my Apple phones? Like you own a tiny tiny share on my phone, or a tiny share of the company, or see Tesla's driving around. Like you own a piece of that car. Like you own a piece of that company. So it's
pretty
gives
cool.
us a sense of empowerment. Like, hey, like I actually like another vehicle of teaching kids about money and things of that nature. Many of us work with kids, mental school social work, like myself, working it now, or just so many other social workers that I've met, like doing stuff with kids, and like they don't teach any of this stuff, in the school system, unfortunately. So it's good to find different vehicles to teach kids about financial literacy, and just people in general. So and going back to the 401ks and for 403bs and stuff like that, I learned there's some fees that comes with that if you want to take money out, depending on the funds and depending what's actually in those accounts, that you might not get more bang for your buck. And that's something I've learned within like the last couple of years myself. So when I just started a job in August, and I was like, I saw the 401k, then I looked was in the 401k account, and I was like, this account look kind of trash. I mean, I want to like sign up for this 401k. Might have to like roll over my accounts into something else. So I learned that from like the book Money Master the Game by Tony Robbins. He goes a lot into the fees that are in 401 accounts. So I recommend anybody read that book. I start that book, I stop it, I start it again, and I stop it again. Like, nice. I need to hurry up and finish it.
Nice. Yeah. And you do bring up a couple good points there. You're right about 529 plans. You don't have to take your state specific one. And how do you know whether or not your state specific one is not favorable or not? You do research, and you talk to financial professionals, whether that's someone like myself or someone you find in your area. You do research about your state plan and find out what other plans, what states have good plans, right? And the second thing you mentioned there about, growing the money, right? And you mentioned like, you can get your kids engaged, right? And tell them you own a small piece of Apple or Tesla. When we have those accounts for them, whether it's the 529 and UTMA, right? There's different places we can put it. Usually people end up putting it into like the stock market and investments, mutual funds where they're going to grow. You could put it at a local bank, but one of the cons of putting it in a local bank is it's not going to grow. So, but I think the bigger point I want to make here is you need to obviously get your kids engaged and talk to them, let them know what's going on. Like, my son, yeah, we have a 529 set up. And when he's a little bit older, we're going to let him know what it is. And we're going to let him know about his savings. We're going to teach him things. I'm incredibly thankful. Like one of the reasons I think I'm in this industry as it is because my mom at a young age, she kind of got me interested in learning about money, right? She encouraged me. My first job was working at a bank as a bank teller, right? So she encouraged me to go try working at a bank, So my mom started conversations with me as a child. So talk about money with your kids, help them to understand it so that when they get, to become an adult, they can manage their own money independently as well. And then the last thing there, real quick, is, those fees you mentioned. And those exist in 401k accounts. They exist in IRAs, a lot of different accounts. It's always important to just research those fees and ask questions about those fees. If you are going to hire a financial advisor, a financial professional, whoever the case is, ask them what those fees are. Some of those fees are the commissions they earn. Some of those fees are the expenses to manage the account. So there should be full transparency when you're opening an account, and you should ask questions about what those fees are so you understand the fee structure and how in those accounts.
Yeah, that's definitely great information. Are you taking clients for your business?
Yeah, so I actively manage a book of business that is growing. So I offer the opportunity to individuals to meet with me, complimentary. I never charge a fee to meet with me. I have a 15-minute strategy session where we just kind of talk and get to know one another. And people bring up questions and they say, I have a question about my dad. I have a question about this. I have a question about whatever. In some cases, those people say, I'd like to, work with you. In some cases, people just want to take the, just see me as a resource and take some of the information I give them. But those who decide to kind of go through the process and work with me, we don't charge hourly fees to our clients. If there's an opportunity to help with, one of the companies or products we work with, we obviously get compensated through those companies. So I'm still actively growing my business. So thank you for asking that.
No, of course not. Are you just taking people in Connecticut, or you can take
No,
anybody?
Yeah, the way our business is lined up, as long as you are licensed in the state that the individual works in, then we can work with them. So between myself and one of the partners I work with, we are licensed in a lot of different states. And if we come up, we meet somebody who we're not licensed in, and we find out that that person wants to work with us, we go and get licensed in that state so that we can legally do it.
Oh, awesome. So,
yeah, I have thankfully, again, through the pandemic and Zoom and all our great wonderful technology, I have clients in California, I have clients in Florida, Texas, Virginia, I really span across the United States. The majority of my clients are here in New England. I think that's just a function of where I am, but I do have clients throughout the country. So it doesn't need to be somebody solely here in Connecticut.
Gotcha. Where can people find you?
So I am very active on LinkedIn, active on Instagram, my website, alexcasella.com. My handle is Casella Personal Finance on Facebook and Instagram, and also LinkedIn. I mentioned that, just search by my name. So that's people who can find me.
Awesome. Great info. I really appreciate all the information. I hope people really tuned in and really listen and make some changes with their financial planning. Or if you never start, definitely it's never too late to start. For myself, I'm still learning as I'm going, and figuring, things out. Definitely like to leave like, something in case something does happen. The pandemic is real, and just, right now as of this recording, this is Omicron, and who knows what else is out there with the pandemic. Could be another variant coming soon, so you just never know, and just I'll never know how that's gonna play out, and just dot your I's and cross all your T's, financially, especially if you got kids, and just take it one day at a time.
Yeah, absolutely.
Thanks, Alice. This,
Absolutely.
this was a lot of fun.
Yeah, this was great. I really appreciate it, Baz. Thank you for your time.
No problem. Take
And,
care.
take care.
Take care.